One of the most important things I think that everybody needs to understand when using options in their investing goals, whatever their goals might be, whenever you are investing with options, there is one important thing above all that you have to keep in mind, and that is implied volatility. And this is what runs the whole option game, the volatility of the option contract. Is there high volatility? Is there low volatility? How does that affect the contracts that I want to buy, the contracts that I bought already, the contracts that I want to sell? And once you get a grasp of implied volatility, it makes the whole world of options much easier to understand and much easier to take advantage of. So I will give you an example. We should always be buying options when implied volatility is low, and we should always be selling options when implied volatility is high. Now, the implied volatility of an option is going to be dependent, if it's high or low, is going to be dependent on what the average implied volatility of that stock and option is, right? So, for example, if you have an implied volatility of 50%, that is saying that this underlying stock is potentially going to move 50% up and down in the range of 50% from the current stock price within a 1 year time period, all right? So, and then you can calculate down based off of the 1 year time period, based off of how long you want to hold options for, or how long you're selling options 1 month out, 6 months out. You can better understand the implied volatility move, what the market believes this underlying stock will do in the next year. Okay, and then you take that back and you divide it up to however long your option period is. Okay, so you take a look at the implied volatility, and then you have to understand is that implied volatility high or low based off of the average, all right? And then you have to understand that also implied volatility a lot of the times always reverts back to the mean. So if we have a spike in implied volatility, then chances are it's going to revert back to the mean, all right, or the sort of average amount of the average implied volatility of a given underlying stock. Now, something super important before going forward. Moomoo wants to give you up to 5 free stocks, each valued up to $3,500. Pretty crazy. Moomoo is a free trading app that doesn't accept payment for order flow, which we can all agree is a good thing. Now, the great thing about their app is that even though you're shown a lot of data, which is a good thing, Moomoo interprets everything and explains it all in simple terms right there on the app. And I'll be honest, I've been using it and I really like it. So how can I get these free stocks, you might be asking? Well, it's very simple. Just use the link down in the description, and by signing up, Moomoo will give you 1 free stock. If you then fund your account with any amount, Moomoo will give you another free stock. And if you fund your account with $2,000, Moomoo will give you another 3 free stocks, all of them worth up to $3,500. So check out the link below. Thanks to Moomoo, and now let's get back into the video. So when implied volatility spikes up, generally it reverts back down. And if implied volatility goes down past the midway point of where that got the line here, and it's up and down, right? When it's down, it sort of reverts back up. Right? And this is a concept that is not only with implied volatility, but with a lot of things, right? Moving averages, for example, just in a typical stock movement, right? And standard deviations, if a stock is moving and it's far out, it's a 1 standard deviation away from its mean or 2 standard deviations away from its mean, that means it's going to probably revert back down, okay? Same thing with the implied volatility. So how can we take advantage of that? So again, when you are buying options, the idea that you're buying options and you hope the stock price is going to go up, yes, correct, that you'll make money off of your purchase of call options or put options. You're hoping the stock goes down, and you're thinking about the stock movement and how that affects the options, then yes, you are correct in assuming that if the stock goes up, the call option will also increase. If the stock goes down, your put option will increase, right? But also, I want you to start thinking in terms of implied volatility, in when the implied volatility is low and the implied volatility then increases, your option price, the premium, that contract price, will also increase with the increase of implied volatility. The same thing holds true in reverse. When implied volatility is high, the contract price, that premium price, right, that you see of your option is high because there's a lot of implied volatility baked into it. But when implied volatility contracts down, then what happens to the option price? It goes down, all right? So when implied volatility is low and then it goes high, the option price also will rise. Now, this could be very confusing, especially when you have a collapse in implied volatility and the stock price doesn't move or it goes in the opposite direction. And then you say it happens a lot with earnings, right? There's a lot of implied volatility in a stock for the move because there's a lot of demand for that particular option, and a lot of demand for an option, a particular option, makes the implied volatility increase, right? Increased demand makes the implied volatility rise up. And now let's say the stock doesn't move. Well, then the implied volatility collapses and that option price collapses on you. So even if the stock goes up, the implied volatility will go down further to make that option contract just collapse in value. So a lot of the times in earnings, right, the earnings report goes up and you're like, what the heck? I put money into this and it went up the right way, and then you check the next morning and you're like, I have nothing left in my option contract. And this happens. And that is in a concentrated time period, but this also holds true through long periods of time. So when you see implied volatility go up, we should be selling option contracts, because then when it goes down, the option contract decreases in value, and this is how we make money selling options. When we have implied volatility that is low, you can look to buy options over a long period of time, okay? And then hope that during that time, the implied volatility then will go up. And then that will make your contract increase in value. And hopefully that alongside the stock moving in your correct direction, you will make profit off of that more than just off of the stock movement alone. So implied volatility is a very, very important thing. So sell options when implied volatility is high, hope for the implied volatility to lower, and then buy options when implied volatility is low, and then hope that it goes up. Because it's very hard to make a lot of money selling options when implied volatility is low. When the stock just doesn't move, the price is already baked into the option, right? There's no free lunch here in the stock market. So when implied volatility is very low and you sell options, there's not a lot baked into it, right? I always like to make the comparison of an option contract is like you go out and you order barbecue ribs for dinner. And sometimes the ribs come with a lot of meat on it. And sometimes it comes with just the sauce, and most of it is just bone, right? The meat on a rib is the premium that is baked into it. If there's a lot of meat on the bone, there's a lot of premium. And when there's high volatility, there's a lot of premium baked into it, right? And then when it's just bone, it's like you could even think of it as low implied volatility. There's almost nothing in it. And when we sell options at a point where there's almost nothing in that contract, you're going to get very little premium collected. But then there's very low hope that the implied volatility will drop even more for you to decrease that value of that option contract and you to get more profit, okay? So all the time, the best thing to do is sell, which I love selling options, especially when implied volatility is high, because not only will you use theta decay, the time, to erode that option contract, right? You eating meat off that bone through time, but also through implied volatility lowering, right? So you want to already start in a good position so that you can make profit along the way. And again, on the reverse side, if you're buying options when implied volatility is really high, so let's say the market just starts tanking and already the implied volatility is very high, right? On the S&P 500, let's say, and you want to short the market, right? And buy puts on the SPY index. Well, guess what? If the market stops moving, the implied volatility is going to collapse and you've paid a high premium for that option contract, and then it's just going to lower in price. You're going to lose money and it won't be very nice, okay? So the takeaway to this is learn to understand implied volatility. Learn when it's high, we want to be selling options and then taking advantage of this reversion back to the mean. And when it is low, we can look to buy options and potentially look for a spike in implied volatility, and then that'll make us money, okay? So implied volatility, a very important thing for options. Learn to use it and make some money.